I've always wanted to meet the person who has that voice. The confident voice. The same person that's on the GPSs. Yeah, probably right. Probably right.
Siri's sister.
Yes. I want to welcome the members, staff, and our guests to the June meeting of the Authority, the members of the Authority. It's the first day of summer, I gather, which means it's the summer solstice. It's a beautiful day in Albany, and it's also the longest day of the year. I guess that's what solstice means. I'm not certain if that has something to do with the stars, but it's a lovely day to be
Solstice doesn't
here.
have to do with the length of the day, it just has to do with where the sun is in relation to the tropics, tropic cancer cap.
Well, I want to thank you for that.
Because
You were listening to me.
You have a winter solstice as
Yes,
well.
exactly.
That's the longest day of the year down there.
Al, you've learned a lot.
I have.
Your education continues.
It's been a very educating 2 days for me.
And the longest day does not have to be the longest meeting.
Sorry.
Thank you.
Just thought I would.
No, it
brings back to
I
focus.
promise you that it will.
Thank you, son.
It will not be. We've got a lot to cover today, though, so we'll get right to it. Behind tab 1, you will find the minutes of the May 10th meeting. Has everybody had a chance to review them sufficiently? If so, are there any recommended revisions? Hearing none, may I have a motion, please, to approve the minutes? Thank you, Sandra. Is there a second? Second. Thank you very much, Paul. All in favor, please indicate with aye. Aye. Motion carries unanimously. Behind tab 2 is the report of the Finance Committee. Chairman Lomsky.
Thank you, Mr. Chair. We met yesterday afternoon in Albany. We first adopted the meeting minutes from the May 9th meeting of the Finance Committee. Then we proceeded to discuss 2 offerings. One was the Master BOCES lease refunding revenue bond for Nassau County. The other was the Rockefeller University offering. After some brief discussion, we agreed that they should be, we approved the resolution recommending approval at today's board meeting. We then discussed 2 TELPs. One was the Maimonides? I think I have that right. And also SUNY University Hospital of Syracuse, and we also recommend that they be approved. And that concludes my report, Mr. Chair. Thank you very much.
Thank you very much, Jerry. Any questions for Jerry? Hearing none, the adoption of the financing documents will be led by President Gerard.
Thank you. Good morning. Behind tab 3 is the Jewish Theological Seminary of America credit summary update with bond counsel Hal Patrick Esquire, Harris Beach, and Matt Bergen presenting.
Al, it's good to see you. Michelle, it's good to have you.
Thank you very much, Mr. Carter.
Matt, did you start this?
Yes, I will begin today. So good morning, everyone. This is the financing for the Jewish Theological Seminary of America. This resolution to proceed was brought to the board on April 12th. We have since received the approval of the Public Authorities Control Board. We've had our TEFRA hearing, and we've received the TEFRA approval. And also, as an update, the seeker has been completed. As noted in the credit summary update, the bonds will be purchased by TD Bank, and they were they will be issued in a term mode with a fixed rate of interest for the initial 15 years, and the interest rate for those 15 years is 2.88%, and I thought that was worth noting. And one final update, at the April meeting, we had discussed some historical fundraising, and looking back, I gathered information going back specifically between 2006 and 2009 to capture their total fundraising during that period. And as an update to the board, during that period, they averaged $23 million for that period in time in total gifts and donations.
Thank you for that
Per year.
information.
Per year.
Thank you. Are there questions for Matt before we move to? Yes, please, Sam.
Matt, also at that meeting, we talked about their capital campaign. At that point, it hadn't started. Is there any further update on that?
There isn't. It hasn't started yet.
So how does that figure compare to more recent years, the 23 million average?
The 23 million, they've had some highs and lows. It's been comparable. They had a very strong year in 2016 of 32 million, but they've been in the neighborhood of 21 million, 22 million, 18.7 million, 17 million.
Okay,
So there's been some variation, but it's pretty much in line with the current figures.
Thank you.
Other questions for Matt? Al, please.
Good morning. We're here and proposing for your consideration a general resolution for the Jewish Theological Seminary of America, which will authorize the issuance of one or more series of taxable or tax-exempt bonds, and a series resolution authorizing the issuance of the Jewish Theological Seminary of America revenue bonds, series 2017, not to exceed $51 million. Those will be tax-exempt bond. The institution is a New York Education Corporation. It's exempt from federal taxation under 501c3 of the Internal Revenue Code. And the bonds for the institution will be issued under the authority's authorization to finance facilities for degree-granting institutions of higher education. And as Matt said, the bonds are expected to be purchased by TD Bank. We expect, as Matt said, that the bonds will be issued as a single series of tax-exempt bonds. There will be a 15-year hold period by TD Bank at the end of the 15-year period. They have the option, there will be a mandatory tender at the end of the 15-year period unless the bank and the institution agree to extend that period. And the mechanics of that extension are built into the documents. We're here today with our co-counsel from Brown & Hutchison, Michelle Hutchison, and I'm going to ask Michelle to describe the purpose of the issue and the resolutions.
Good morning, everyone. The institution is undertaking approximately a $100 million modernization of its campus. Proceeds of the bonds will not exceed $51 million. Bonds are expected to be applied to finance portions of the costs of construction of a new library and a new student dormitory, and may pay costs of issuance of the 2017 bonds. The balance will be paid out of the institution's equity. With respect to the general resolution is a new resolution which provides for the issuance from time to time of multiple series of bonds in an unlimited aggregate principal amount for the benefit of the institution. The general resolution constitutes the agreement between the authority and the holders of the bonds issued under it and contains the basic terms of that agreement. The Series 2017 bonds will be the first series of bonds under this general resolution. The bonds may be issued under the general resolution for one or more of the following purposes: to finance or refinance the cost of one or more projects, to fund a debt service reserve fund if one is established by a series resolution, and to finance the costs associated with the issuance of the bonds. Each series of bonds is secured by revenues consisting of payments to be made by the institution under the loan agreement as security, for the payments by certain funds and accounts established for the series of bonds, and by any other security pledged to the payment of the bonds. The general resolution sets forth the general terms that apply to each series of bonds, conditions for issuance of each series of bonds, and security for the bonds. The bonds must be fully registered form and may be issued in book entry form. The bonds which may be authorized to be issued under the general resolution may be fixed rate bonds, capital appreciation bonds, deferred income bonds, option bonds, or variable interest bonds. The bonds of each series are special obligation bonds of the authority, payable solely out of the revenues pledged therefor, the monies and investments held in the funds, and accounts established by the general resolution and the applicable series resolution. The general resolution authorizes the authority to establish and fund a debt service reserve fund and a series resolution that will secure payment of the debt service on only that series of bonds. The Series 2017 resolution does not establish a debt service reserve fund for the 2017 bonds. U.S. Bank National Association will be the trustee for the Series 2017 bonds. Excuse me. The Series 2017 resolution authorizes the issue of up to $51 million aggregate principal amount of the Series bonds. The Series bonds will be secured by the funds and accounts established pursuant to the Series resolution, other than the arbitrage rebate fund. The revenues, the authority's security interest in the pledged revenues under the loan agreement, and the authority's rights under the mortgage. The institution will be permitted to incur indebtedness secured on parity with the pledged revenues and the property, subject to the mortgage, subject to the consent of the authority and the purchaser. No disclosure document will be prepared by the authority or institution in connection with the bonds. In accordance with the authority's issuance guidelines, the Series 2017 resolution contains restrictions on the ownership and transfer of the series of bonds to qualified investment buyers only, or QIBs. The authority will assign at closing its rights under the loan agreement and the mortgage to the trustee pursuant to an assignment agreement. The series resolution delegates to various officers of the authority the various powers, among others, to determine the principal amount of the bonds to be issued but not to exceed $51 million, the date or dates on which bonds will mature, provided no bond may mature later than 31 years after July 1st next, succeeding the date of issuance. The rate or rates at which the Series 2017 bonds will bear interest, provided that the initial interest cost shall not exceed 7.5%. And the terms of sale of the bonds at private sale, provided that in each such private sale, the purchase price shall not be less than 95%. The Series 2017 resolution also authorizes various officers of the authority to execute the assignment agreement, a bond purchase agreement, and do all things necessary and convenient in connection with the sale and issuance of the bonds.
Michelle, thank you.
Thank you very
The
much.
loan agreement between the authority and the institution that will be executed in connection with the issuance of the bonds will provide requirements for the institution to make payments of principal, sinking fund installments, if any, and interest on the bonds. And also, under the loan agreement, all amounts of fees, costs, and expenses of the authority are to be paid directly to the authority. The institution's obligations under the loan agreement are general obligations of the institution payable out of any monies legally available to the institution. The obligations under the loan agreement are absolute and unconditional as to the amount, manner, time of payment. The security under the loan agreement will be the pledge revenues, which is the gross receipts of the institution, and also a mortgage on the project. And those two features will secure the obligations under the loan agreement. It's expected that the institution will also enter into a continuing covenants agreement with TD Bank, which will establish the conditions and covenants between the borrower and the bank. A default under that agreement will also constitute a default under the loan agreement. The bank's agreement, the continuing covenants agreement, may also contain other covenants, financial and otherwise, that the bank requires as a condition for purchasing the bonds. As Matt noted, the bonds are going to be sold privately to TD Bank, and only QIBs are allowed to purchase the Series 2017 bonds, so any transfer by TD Bank can only be to another QIB. And the proceeds of the bonds are going to be applied to pay costs of the project. We've mentioned that they also pay costs of issuance. At this time, it's anticipated that the borrower will pay all costs of issuance out of equity. All of the loan proceeds will go into the hard costs of the project. Copies of the general resolution, series resolution, loan agreement, bond purchase agreement, and other documents will be available at the offices of the authority and the trustee. Thank you. If there are any questions, I'll be happy to answer.
Thank you both. Are there questions? Yes, Sandra.
Where in Manhattan is the institution?
It's right up by the Riverside Church. If you go into the West Side Highway, you'll see Grant's Tomb. And then if you went over, I think it's 122nd and Broadway.
Is the Does the project expand the footprint, and are there any issues with community board or unhappy neighbors?
It doesn't expand the footprint. In fact,
It does not.
It does not. The institution sold a portion of the footprint of its site, roughly a third of the plot, for a substantial amount of money, as I think you've already heard. The remaining site, buildings were demolished, and the new buildings are being built on the site of the demolished buildings, and that demolition has already occurred. So there were no persons who came to the TEFRA hearing, had no comments on it. The only community opposition was anticipated but hasn't materialized. So far, everything looks good.
Other questions for Matt, Hal, Michelle? Hearing none, the resolution is found just after Appendix B, behind tab B, it's A. You've had a chance to take a look at it, and may I have a motion, please, to approve? Thank you, Gerard. Is there a second?
Second.
Thank you. All in favor, please indicate with aye. Aye. Are there any opposed? Motion carries unanimously. Thank you all very much.
Thank you very much.
See you.
Thank you.
Behind tab 4 is the Master BOCES lease refunding revenue bonds. Nassau County credit summary, bond counsel, Leeds, Brian Esquire, Brian Gravino, and Steve Kosher presents.
Morning.
Steve, Brian?
Morning.
Seth, I'm sorry. Brian Gravino. Forgive me.
The single approval staff report presents tax-exempt fixed-rate bond issue in an amount not to exceed $14 million to advance, refund all or a portion of the Series 2009 bonds issued by DASNY on behalf of the Nassau County BOCES. The Nassau BOCES also has Series 2011 bonds outstanding with DASNY. The bonds are expected to be rated AA2 by Moody's. Bonds will be secured by annual rental payments to be made pursuant to a lease agreement with Nassau BOCES, a direct intercept through the state comptroller of any state aid due to Nassau BOCES for rental payments on the DASNY lease agreement, pledge of public funds apportioned by the state due to Nassau BOCES in an amount sufficient to pay such rental payments, subordinate to pledges granted in connection with other outstanding Nassau BOCES DASNY bonds. There will also be a 1/2-year debt service reserve fund or a reserve fund facility, and bond insurance may be considered depending on its availability and economic efficiency, although at the AA2 rating, we don't expect there to be bond insurance on this transaction. The refunding bonds will have a final maturity which will not exceed the final maturity on the bonds being refunded, and the refunding is expected to result in net present value savings of approximately $826,000 or 6.9% of the bonds being refunded.
Thank you, Steve. Seth?
Good morning. Today, the members of the authority are being asked to consider, in the board's discretion, to adopt a series resolution for up to $14 million of Master BOCES program lease refunding revenue bonds, Series 2017, which, if adopted, will be issued on behalf of the Board of Cooperative Educational Services of the sole supervisory district of Nassau County. The series resolution falls under DASNY's Master BOCES Program Lease Revenue Bond Resolution, which is a general resolution adopted on August 15th of 2001, and as supplemented by a first supplemental resolution on February 25th, 2004, and a second supplemental resolution adopted on March 11th, 2015. If approved, the Series 2017 resolution authorizes bonds to provide monies to refund and defease all or a portion of the outstanding 2009 Nassau bonds, the proceeds of which were used for the cost of acquisition of property located at 1 Merrick Avenue, Westbury, New York, for use by the Nassau BOCES as an office building and a teacher training center. Proceeds might also be used to fund the debt service reserve fund and or to pay the cost of acquiring a reserve fund facility with respect to the Series 2017 bonds, to pay the cost of a policy of municipal bond insurance, if any, with respect to the Series 2017 bonds, and to pay all or a portion of the cost of issuance for the Series 2017 bonds. The Series 2017 bonds are anticipated to be authorized to be issued as fixed-rate bonds. And the Series 2017 bonds are proposed to be sold in a negotiated sale to M&T Securities pursuant to a bond purchase agreement that has terms customary for DASNY bond issuance. By way of background, under Section 1689 of the Dormitory Authority Act, DASNY is permitted to issue bonds to finance or refinance the cost of construction, to finance or refinance the cost of constructing Board of Cooperative Educational Facility school facilities. Under the Act, DASNY is authorized to become a lessee of such facilities and to lease back such facilities to the BOCES. The lease to DASNY may be at a nominal fee. The lease from DASNY to the BOCES must set basic rent at levels which I'll describe. In terms of the mechanics for this transaction, it's anticipated that DASNY will enter into an amended and restated agreement of lease and an amended and restated lease and agreement with the Nassau BOCES, which will amend the respective agreements related to the Series 2009 bonds. DASNY will pay nominal rent to the Nassau BOCES, and DASNY will then in turn lease the school facilities back to the BOCES pursuant to terms that I'll describe. The Act provides that DASNY shall file a certificate annually with the Commissioner of Education stating all amounts due from the BOCES to DASNY under the leases, with the BOCES described herein. Upon receipt of a certification from the Commissioner of Education, the State Comptroller is required to deduct the amount certified by the Commissioner as due to DASNY from the state aid otherwise payable to the BOCES, and to pay that amount directly to DASNY for debt service payments. If the state aid is insufficient, the BOCES remains obligated to pay the rent under the lease agreements. The Series 2017 bonds will be special obligations of DASNY payable solely out of the revenues and monies and investments held in certain funds and accounts established by the Series 2017 resolution. With respect to the Series 2017 bonds, revenues consist generally of basic rent to be paid by Nassau BOCES under the amended and restated lease agreement on account of debt service on the Series 2017 bonds, and payments to be made out of the payments to be made by the State Comptroller to DASNY out of state aid otherwise payable to Nassau BOCES. Payment of the Series 2017 bonds is secured by the pledge and assignment made by the general resolution of the revenues, certain monies and investments, including a debt service reserve fund held under the general resolution and DASNY's rights thereto. The pledge and assignment shall be subordinate to the pledge and assignment made by BOCES, by the Nassau BOCES, in order to secure the authority's 2009 series Nassau bonds, if any shall remain outstanding, and the authority's Series 2011 bonds with the Nassau County BOCES, which is in the principal amount, which was issued in the principal amount of $24,785,000. Under the general resolution, resolution constitutes the basic agreement between DASNY and the holders of the bonds issued under the general resolution. The general resolution provides for the issuance from time to time of multiple series of bonds in an unlimited principal amount. Each series of bonds issued under the general resolution is to be secured separately from the other series so that the general resolution may be utilized to provide financing or refinancing for any BOCES in the state of New York. The general resolution sets forth the general terms for any series of bonds, conditions for issuance of any series of bonds, securities for the bonds, funds and accounts and flow of monies through such funds and accounts, events of default, remedies, provisions regarding amendment to the general resolution, provisions regarding the fiduciary's covenants of DASNY, and the defeasance provisions, among other terms. With respect to the Series 2017 resolution, the Series 2017 resolution authorizes the issuance of the bonds in an amount not to exceed $14 million and otherwise consistent with the general resolution. The Series resolution delegates to the officers of DASNY the power to, among other things, determine certain matters with respect to the bonds, including the date or dates on which any Series 2017 bonds will mature, provided that no Series 2017 bonds that are issued to refinance the 2009 bonds will mature later than the latest issue of the Series 2009 bonds, which is 2028. The officers are also delegated the authority to determine the principal amount of the Series 2017 bonds the date or dates on which the principal and interest on the Series 2017 bonds are to be paid, the rate or rates at which the Series 2017 bonds will bear interest, provided that the true interest cost on the bonds may not exceed 7.5% per annum. The officers are further delegated the power to determine the purchase prices for the bonds to be paid on their initial sale to the underwriters, provided that the Series 2017 bonds are not sold at a price that is less than 90% of the principal amount of the Series 2017 bonds. The officers are permitted to determine the redemption dates, if any, provided that if there is a redemption, price should not exceed 103% of the principal amount of the Series 2017 bonds. Further, the officers are delegated power to determine whether or not whether the bonds will be insured, as Steve alluded to, or whether a letter of credit or surety bond may be employed. The Series 2017 resolution further delegates to the officers of DASNY the power to prepare and distribute a preliminary official statement and official statement, to execute a bond purchase agreement, the amended and restated lease agreement, and all other documents necessary or desirable to close in the Series 2017 bond offering, including a memorandum of understanding between the state commissioner, the Commissioner of Education, and the state comptroller and DASNY. Thank you very much.
Seth, thank you. Steve, thank you. Any questions?
Seth, you wrote one of the longer and more detailed legal opinions, and congratulations, well done.
I'm not sure if that's a compliment.
Absolutely a compliment.
I'll take it.
I'll take it. You're welcome.
Coming from him, it's a real compliment. Hearing no questions, may I have a motion, please, to approve the resolution? Sandra, thank you. Is there a second? Elizabeth, thank you very much. All in favor, please indicate with aye. Aye. There are none opposed. The motion carries unanimously. Thank you both.
Thank you.
Good to have you.
Thank you. Behind tab 5 is the Rockefeller University Single Approval Credit Summary with bond counsel Jennifer Wheeler Esquire of Nixon Peabody and Dave Ostrander presenting.
Jennifer, it's good to have you.
Thank you. Nice to be here.
The staff report provided to the members presents one series of tax-exempt and/or taxable, fixed and/or variable rate bonds in an amount not to exceed $102 million, with a term not to exceed 35 years on behalf of Rockefeller University. Bond proceeds will be used to refund all or a portion of the Rockefeller University Series 2009 bonds, which have a current par amount outstanding of $100 million. The 2009B variable rate demand bonds, which currently bear interest in the weekly rate mode. The interest rate is determined based on the results of a weekly remarketing of the bonds by a remarketing agent. And the bonds have a liquidity facility in place, which is provided by U.S. Bank in the form of a standby bond purchase agreement. Similar to other Rockefeller University bonds, the 2009B bonds are structured with a bullet maturity that matures on July 1st, 2040. The Series 2017 bonds, which will be issued to refund the 2009B bonds, are expected to be sold through a private placement with TD Bank. The bonds were expected to be issued as variable rate with an interest rate reset monthly based on the tax-exempt equivalent of 30-day LIBOR plus a spread. TD Bank has agreed to hold the bonds for a period of 10 years from the date of closing, at which point there'll be a mandatory tender if the university does not refinance or negotiate a renewal with the bank. The final maturity will be extended to match the useful life of the asset that was originally financed with these 2009B bonds up to a maximum of 35 years. It's expected that there will be no principal amortization during the hold period, and the bullet maturity would remain in place. There's a few reasons why the university is choosing to refund the 2009B bonds. The first of which is to reduce their exposure to variable rate demand bonds. Rockefeller has a total of 3 series of VRDBs outstanding, totaling $250 million, which include the 2009B bonds. So this refunding would reduce that exposure by $100 million and move it to a different variable rate product, which is based on LIBOR instead of the weekly remarketing. It's also worth pointing out that this the LIBOR rate for the private placement better matches up with the university's outstanding swap on the 2090 bonds. Also, with regard to the liquidity facility, there's downgrade risk and renewal risk. If U.S. Bank, which is the standby bond purchase provider, were ever downgraded, that would impact the short-term rating on the bonds. And there's also a renewal that needs to be done every 3 years. So by privately placing these bonds, you take that risk off the table. There's also the cost of the remarketing agent as well as the liquidity facility. With regard to Rockefeller, DASNY has issued bonds for 40 years for Rockefeller, totaling over $1.1 billion. Most recently, back in 2015, we financed the River Campus, which is currently under construction, and will extend the university's campus over the FDR Drive. Since this will be a private placement, the bonds will not be rated, but the university's outstanding obligations are rated AA1 from Moody's and AA+ from S&P. The university's reputation in the field of biomedical research enables it to draw on its diverse revenue sources, which include government grants, philanthropy, and investment income. And Rockefeller has a very large financial resource base, which reflects that strong fundraising as well as a history of sizable investment returns. So as of June 30th, 2016, the university had total net assets of over $2.3 billion and expendable resources of over $1.9 billion. And those expendable resources are reflected in the university's viability ratio of 2.6 times and the primary reserve ratio, which is 5.4 to 1, compared to the DASNY median of 0.8 to 1. The university is highly leveraged, which is reflected in their debt burden ratio, and much of this is related to the large capital expansion that's ongoing. But despite the level of debt, the university's debt coverage ratio over the last 5 years has averaged 1.7 times. And with this being a refunding, there'll be no additional debt on the university's balance sheet. Mr. Chairman.
Thank you, David. Questions for David? Yes, sir.
David, as I understand from the material and what you're saying, that if you were to summarize the reason for doing it, is a lot of risk avoidance and cost avoidance in it. Are there any calculations that support why that is worth the cost of doing the issuance?
I wouldn't say there's calculations. I think, last year or 2015, they also took out some of their variable rate demand bonds and put it in a private placement. Again, that was based on LIBOR. So I just think they're trying to spread out their risk a little bit instead of having all their eggs in one basket with the VRDBs, which was most of their bonds. So I think, they're not avoiding the risk. There's risks on both sides, but I think they're just trying to spread it out a little bit. And with the swaps that they have outstanding, they don't really have the option at this point to move into fixed rate bonds.
But there has to be some way of judgment of that this risk is better than that risk, and there is some cost of what they're doing.
Right. There's also, it does match up better with their swap, so that's a positive. There is the cost of the liquidity facility and the remarketing agent, so that's something that they wouldn't have to pay when the bonds are privately placed. So I think the combination of all those things sort of led them in this direction. And they received pretty favorable rates from TD Bank, which I think wasn't an option back in 2009.
Please.
There's also some anticipated extension of the debt. Do we have any sense of how long that extension might be for?
It could be out as far as 35 years. That decision hasn't been made by the university yet. I believe that the tax review is nearing completion, which it sounds like it would support that final maturity. But ultimately, it's the university has not made that decision at this point.
And then finally, community board, neighbor issues with the project, including the Esplanade.
No issues at all.
Who could be upset with this?
Everyone loves Esplanade.
We'll go for a walk on it.
Yes, we will do that.
Thank you.
Jennifer, please.
Thank you. Good morning. Before you today for your adoption is a new revenue bond resolution authorizing the issuance by the authority of its Rockefeller University Revenue Bonds 2017A issue in an amount not to exceed $102 million. The university expects that the bonds will be purchased by TD Bank in a private placement. The revenue bond resolution authorizes bonds to be issued to refund certain bonds of the authority issued in 2009 and to pay cost of issuance of the 2017 bonds. The 2009 bonds were issued to finance or refinance the cost of construction, renovation, and capital expenditures of various facilities on the university's campus in Manhattan. The bonds will be issued as variable rate tender option bonds, which rate is contemplated to be adjusted monthly based on LIBOR rates. TD Bank is expected to hold the bonds for a period of 10 years, during which time TD will not have the right to tender the bonds for purchase. Prior to the end of the 10-year hold period, TD may elect to continue to hold the bonds. If TD elects not to continue to hold the bonds at the end of the hold period, the bonds will be subject to mandatory tender, at which time they may be remarketed in either a public offering or to one or more qualified institutional buyers in another private placement. The revenue bond resolution authorizing the bonds further delegates to various officers of the authority certain terms of the bonds, including the final maturity date, which shall not be more than 35 years from the date of issuance, the interest rates on the bonds, provided that the true interest cost does not exceed 7.5%, and the terms of redemption or purchase in lieu of redemption on the bonds. The revenue bond resolution also authorizes various officers to execute a bond placement agreement and all other documents necessary and convenient for the sale and issuance of the bonds, as well as the refunding of the 2009 bonds. In connection with the issuance of the bonds under the revenue bond resolution, the authority will also enter into a loan agreement and a collateral assignment of loan agreement. A loan agreement will require the university to make payments in the amounts and at times sufficient to make timely payments on bonds, the principal, the sinking fund installments, redemption, purchase price, and interest. The loan agreement and the obligation of the university to make payments under the loan agreement are general obligations of the university. The university's obligations under the loan agreement are not secured by a pledge of or security interest in any assets or property of the university. The loan agreement will contain certain financial covenants that are consistent with the authority's guidelines. The collateral assignment of loan agreement will assign to the trustee the authority's rights, titles, and interest in the loan agreement, subject to the retention of certain reserved rights. And finally, the bonds, as has been discussed, are expected to be purchased by TD Bank in a private placement. The sale will be effectuated through a bond placement agreement, which contains terms and conditions customary in connection with the sale of the authority's bonds. Thank you.
Jennifer, thank you. Are there questions for Jennifer? Or more questions for David? Hearing none, may I have a motion, please, to approve the resolution? Charlie, thank you. Is there a second? Paul, thank you very much. All in favor, please indicate with aye. Aye. Is there none opposed? The motion carries unanimously. Jennifer, it's good to have you here at the table. Please give John and Virginia this board's warm regards.
I will.
Behind tab 6 is the Maimonides Medical Center health transaction with Portia presenting.
Thank you very much. Behind tab 6, again, is the health financing for Maimonides Medical Center in an amount not to exceed $25 million. As you know, it's the policy of Public Authorities Control Board that financings which exceed $10 million in 12-month period be brought both before the authority and the PACB for approval. There is an attached equipment list where you will see that the equipment includes things such as IT, operating room, and physician exam area equipment. Mr. Chairman.
Thank you very much, Portia. Are there questions for Portia? Hearing none, may I have a motion, please, to approve? Thank you, Senator. Charlie, thank you. Second. All in favor, please indicate with aye. Aye. Is there none opposed? The motion carries unanimously. Tab 7, Mr. President.
Behind tab 7 is the State University of New York University Hospital at Syracuse health transaction with Portia presenting.
Thank you very much. The second health transaction here is on behalf of SUNY University Hospital at Syracuse in an amount not to exceed $23.2 million. Again, it's the policy of the Public Authorities Control Board that TELP financings which exceed $10 million in a 12-month period be brought before the board and PACB for approval. The attached equipment list sets forth various equipment, including information technology, nursing, and radiology equipment. Mr. Chairman.
Portia, thank you. Questions for Portia? There being none, may I have a motion, please, to approve? Thank you, Sandra. Is there a second? Charlie, thank you. All in favor, please
I need
indicate
to
with aye.
recuse myself from this vote since I'm on the upstate medical council board.
I'll accept the recusal. Thank you, John. With that said, the remaining board members, I'm sorry, has gotten the motion, I've gotten the second. All in favor, please indicate with aye.
Aye.
And the minutes will reflect that John has recused himself from the vote.
It's a general question, Portia, on this. This is a policy that could be changed by a majority vote of the Public Authorities Control Board. Does it exist elsewhere?
I'm sorry, Sandra, I didn't understand.
Policy
the
that requires the $2 million.
question. I
Yeah,
see.
I'm not sure of the exact mechanism, Sandra, of how this could be changed by the PACB, but we could certainly talk to them about changing this. I'm assuming you're suggesting that the threshold be increased.
Well, it's come up from time
Yes.
to time that it's been a long time.
Yes.
And this is equipment that one would think that it might make some sense.
Yeah, absolutely, we can do that.
But I erroneously thought that it was either in law or regulation. I didn't just notice this language that was not.
It may also be reflected in our own resolution.
We'll take a look. Yeah,
It'd be in
understood.
all-
Understood.
And yeah, we have certain resolutions for TELP transactions, and it may be in there too.
Okay. Thank you.
It's hard.
Oh, I'm sorry. I'll ask.
Along those lines, how many TELP transactions do we have through the Dormitory Authority that do not come before the board on an annual basis?
It differs from year to year. This actually, we'll talk about a little bit later, Charlie, when I go through the annual bond sale summary report. But in your packet, there's some slides, and the very last slide in the presentation for the annual bond sale summary, annual bond sale report includes a slide that shows above 10 million and below 10 million, both for this year and the previous 4 years, so for over a 5-year period. So we can look more at that when we talk about the annual bond sale report.
Thank you, Portia.
Because they also come before the board if there's a certain number of issues per calendar, per year as well.
If the total goes above 10.
The next agenda item is the Audit Committee report. Chairman Gardner.
I will try to be brief. We had a meeting of the Audit Committee yesterday to consider the annual financial statements, the annual investment report, and the Public Authorities Accountability annual report. We had a little bit of discussion yesterday about how we may be able to better parse through the big financial statements, which include all of the pass-through obligations, and look at our own numbers as an operating entity. In fact, we did quite well last year as an operating entity, and we talked a bit about that. I think it was an undramatic meeting in terms of the results, the report of the auditors, the performance of the people, with the possible exception of the audit chairman, who allowed the meeting to pursue its own organic path, unfettered, labyrinthian, intellectually disheveled fashion. And as a result of that, each of the presenters that come after me will hand the baton to each other without any further interference from me. Is
Yes.
Greg?
Yes, the auditors are here.
And Benny?
Yes.
And
Good morning.
Greg, Jeff, thank you. Well,
Thank you. For the record, I am Greg Driscoll. I'm the lead engagement partner from KPMG on the DASNY audit. To my right is Benny Hadnot, managing partner from Watson Rice, and to his right, Jeff Coach, our engagement senior manager on the DASNY audit. We are here to present the results of our audit of DASNY's 2017 financial statements. As Chairman Gardner mentioned, we did provide a presentation to the audit committee yesterday. The materials from that presentation are behind you on the table over here, if any of the board members or management would like to take one with them. So we are going to do, in the spirit of the opening remarks, an abbreviated version of that presentation for you today. Focus on the scope and deliverables that are provided as part of our audit and the audit results. So starting with the scope, the objective of an audit of financial statements is to enable us to express an opinion about whether the basic financial statements that have been prepared by management with the oversight of the audit committee are presented fairly in all material respects in conformity with generally accepted accounting principles, or as we refer to, GAAP. We plan to perform the audit to obtain reasonable assurance about whether those basic financial statements taken as a whole are free from material misstatement, whether from error or fraud. We cannot provide absolute assurance because as part of our audit, we don't audit every transaction of the entity being audited, and there are assumptions and estimates that are embodied in those financial statements that the results of which can't be known until future events actually occur. However, reasonable assurance is a high level of assurance, although not absolute. Our audit included performing tests of the accounting records and other procedures that we considered necessary in the circumstances based on our judgment, including the assessment of the risks of material misstatement to provide a reasonable basis for our opinion. And we also evaluate the appropriateness of accounting policies used and the reasonableness of significant accounting estimates made by management, and we evaluate the overall basic financial statement presentation. As far as deliverables for the audit, the main deliverable is the auditor's report on the basic financial statements with accompanying required supplementary information. That audit report will be dated today, June 21st, 2017. We also provide an auditor's report on supplementary information. DASNY publishes 6 supplementary schedules that are not required by GAAP. We perform audit procedures on those schedules and provide assurance as to the fair presentation of those schedules in relation to the financial statements taken as a whole. As a byproduct report of our audit that is performed in accordance with government auditing standards, we issue a report on internal control over financial reporting and compliance and other matters based on an audit of financial statements, again, as I mentioned, performed in accordance with government auditing standards. That is not an opinion on the effectiveness of the entity's controls. However, within that report, to the extent that we tested the operating effectiveness of controls, if we identified material weaknesses or significant deficiencies in those controls, or a material instance of noncompliance with laws and regulations, contracts, and grants, those findings would be included in that report, and we'll get to the results in just a moment. We also issue an examination report on DASNY's compliance with the requirements of Section 201.3 of Title II of the Official Compilation of Codes, Rules, and Regulations of the State of New York related to investment policies and procedures. And then lastly, we issue a letter to the Audit Committee indicating matters covered by Statement on Auditing Standard number 114, required communications to the Audit Committee and those charged with governance. Moving to the results, the good news is we will be issuing an unmodified opinion on those basic financial statements. As I mentioned, that report will be issued today after the board meeting is completed. As far as the conduct of the audit, there were no significant deviations from the audit plan that was presented to the Audit Committee back in October of 2016. DASNY's accounting policies are described in Note 2, and they're generally consistent with those applied in prior periods, with the exception of changes resulting from the adoption of GASB Statement number 72, fair value measurement and application. And Kim, I think, will speak a little bit to that in her remarks. We've had discussion with management about the quality of such accounting policies as applied in financial reporting, and they appear appropriate given the circumstances within which DASNY operates. We identified no transactions that were both significant and unusual or that lacked authoritative guidance or consensus. As far as management's judgments and assumptions, we evaluated those relative to accounting estimates, including the other post-employment benefit liability, the net pension liability, as well as the valuation of DASNY's interest rate swaps. We had no proposed uncorrected or corrected audit adjustments that were identified through the audit. We identified no material weaknesses or significant deficiencies in internal control over financial reporting. We are unaware of any consultation by management with other accountants regarding current year transactions. There were no major issues discussed with management, the results of which were a condition of our engagement. We had no disagreements or significant difficulties with management. There are no unresolved accounting or reporting issues. As far as other significant written communications with management, we have our engagement letters, as well as management representation letters, which we received at the conclusion of the audit, which provide certain representations and assertions by management that are embodied in the financial statements. I mentioned the other deliverables. We'll also be issuing unmodified reports on the investment compliance as well as the supplementary information that I mentioned. We identified no matters that would rise to the level of being documented in a formal management letter related to internal control over financial reporting. And we confirm that as of today, we are independent accountants with respect to DASNY under relevant professional and regulatory standards. And that concludes our remarks on the audit, and we'd like to take any questions that the board may have.
Are there questions for the auditors? Hearing none at this point, John. Kim, is this where you pick up? Then pick up.
Thank you, Al. Good morning, everyone. I want to review a few of the more high-level items in the financial results that were included within the management's discussion and analysis portion of the materials you received last week. First, in the executive summary, we did have another good year. Our bond issuance line of business saw over $6.5 billion worth of issuances. Construction management, we continued work with NYCHA and GOSER on projects there. The other item that I highlighted in the executive summary is related to the new GASB rules associated with the fair value of our investments. We had to implement this year new rules associated with disclosures, so there were no changes to the financials themselves. Really, the new rules are just intended to give users a little additional information in terms of their ability to assess the reliability of the underlying information that we use to develop the fair value of those investments. Looking at our financial results, the financial statements do show an $8.8 million loss overall for the authority. That is driven by our restricted funds, our conduit debt, as John had alluded to. When we look internally at our operations, we did improve from last year's $2.5 million loss, where we were a little above break even, just about $1 million worth of earnings this year. Our construction management activities were essentially break even. We expect that to be the case, as most of the work there is on our public clients and we build in a cost. Our financing activities, when we look at both our issuances and bond administration, were favorable last year. Here it was because of an increased proportion of work on our public clients. In terms of the other New York State initiatives that we support, for which we have no funding source, the earnings that we had on the financing side were sufficient to cover the support of those various initiatives. Looking at a little bit more detail on the lines of business, we did issue, as I said, over $6.5 billion worth of debt last year. 95% of that came from refundings and new money, with over 50% coming from new money issuances, and that was fairly well split between our public and private clients. In terms of the overall distribution between private and public, we continue to see the majority, or in this case 55% for 2017, coming from our public clients. When we look at our retirements, we had just over $6 billion in retirements for the year, and about half of that came from refundings when we issued new DASNY bonds, and a little over 50% again came from our public clients. We ended the year with just under $48 billion in outstanding bonds, a slight increase, $600 million for the year, and about 2/3 of that was coming from our public clients. Our construction management activities increased year over year. We saw about a $400 million increase, and that was primarily on the certified disbursements side of the business. We had more work for our private clients. In terms of our net position, it remained relatively stable from 2016. And our investment balances also were relatively stable, ending the year at $3.7 billion, and over 80% of that remains, as it has been in the past, largely attributed to funds that have been invested for construction projects, funding grants that we administer, as well as supporting subsequent debt service obligations. Are there any questions on the financials? And Al, may I have a motion to approve the financials for filing?
If the members will look behind tab 8, there's a very simple resolution, which if approved, will approve the basic financial statements for fiscal year. It's a one-sentence resolution. I've had a chance to see it. May I have a motion, please, to approve it? Is there a second? Thank you very much, Paul. All in favor, please indicate with aye. Aye. As there are none opposed, the motion carries unanimously.
Thank you, Al. Moving on to our investment report. We are required to file annually an investment report with the Office of the State Comptroller. The report includes our investment guidelines, our financial statements, and a summary of our investment income that we earned for the year and fees paid for the year. There was one change in our investment guidelines during the year. That was to add irrevocable letters of credit issued by a Federal Home Loan Bank to our acceptable collateral. The board approved that in February 2017 meeting. Are there any questions on the investments report?
Hearing none, behind tab 8 again, that resolution, very near the end of the material behind tab 8, very simple resolution. You've had a chance to review it. May I please have a motion to approve? John, thank you very much. Second. Paul, thank you. All in favor, please indicate with aye. Aye. As there are none opposed, the motion carries unanimously. Ken?
Thank you, Rob. George, if you would like to present the budget report.
Yes, thank you. Thank you, Kim. Good morning. As you see in the Public Authorities Accountability Act annual report, there were a number of accomplishments DASNY achieved this year. I will highlight some of this excellent work by DASNY later in this meeting when I give my report to each of you. For now, I will walk you through some of the other key elements that are highlighted by the ABO report. Fiscal year 2017 was robust. Our Public Finance Division completed 34 bond financings, including one reoffering for a total of approximately $6.7 billion. They also completed 8 lease transactions with a total value of approximately $144.2 million under our tax-exempt leasing programs. This included the $829 million issuance on behalf of New York University, the largest for a private client in DASNY's history. Construction expenditures on DASNY managed projects totaled approximately $633.7 million. We ended the fiscal year with a pipeline of 949 projects valued at almost $6 billion. We also achieved a 29.1% MWBE participation rate on our contracts, even as we continue to progress older contracts that we had lower goals set before the governor's current 30% target. We also had our 40th certification through the Leadership in Energy and Environmental Design program, also known as LEED. Our success in public finance and construction did not come without challenges. As you know, we have taken a number of steps in recent years, including the last fiscal year, to improve our ability to better compete for public finance business and are working to reduce construction overhead costs, particularly on smaller projects. We are continuing to address these challenges in the current fiscal year by focusing our operational efficiencies and enhanced client research. Again, I will go into greater detail on DASNY's wonderful year and my President's report later on during this meeting. Before I conclude here, I would like to extend a hearty thank you to all of DASNY's committed and dedicated staff who serve as the backbone to our organization and all that we achieve. I would also like to specifically thank those who worked hard to put together this year's annual reporting to the authority's budget office and our annual audit. This indeed is a big lift every year. It is without a doubt a team effort to get these reporting projects done on time and with accuracy, but every group effort needs leadership for success. So thank you, Kim Nadeau, Paul Koopman, Portia Lee, Freeman Klopo, and Mike Cusack for your hard work in bringing all of this together. That concludes my report, Mr. Chair.
Thank you, Mr. Chairman. There is behind tab 8 a resolution which, if approved, will approve the annual report to the public authorities. Under the Public Authorities Accountability Act. That resolution has been revised slightly. Mike, will you
certainly
tell us what happened?
Yes, we had a recommendation from staff between mailing and today to take out some of the legacy language because all of the requirements for the ABO reporting are within the public authorities law, and instead of referencing the two acts, the two prior acts from 2005 and 2009, more broadly now refers to the entire body of the public authorities law.
And that revised resolution is in the stack of paper that each of you got this morning from staff. Again, the revisions are entirely administrative.
So there are no other requirements in the public authorities law that are outside the two cited acts? Are we broadening the report by doing this?
No, the two acts are within the public authorities law, so as a matter of efficiency and language,
But the
we've
other way
cited
around, by referencing the general law, are we adding additional reporting requirements?
No, we're not.
Are there questions? Hearing none, may I have a motion, please, to approve the resolution? John, thank you very much. Charlie, thank you for the second. All in favor, please indicate with aye. Aye. As there are none opposed, the motion carries unanimously. Kim, is there anything further? Thank you very much. I want to thank our auditors for joining us this morning and for all the work that you did in support of our financial statements.
Thank you, Mr. Chairman. Appreciate it.
Thank you very much.
Good to see you all. Thank you.
The next agenda item is the report of the President.
Thank you. Thank you, Mr. Chair. So we want to highlight a couple of things. First, DASNY is playing a central role in a rising scientific research corridor. We financed and built CUNY's approximately $700 million Advanced Science Research Center and issued $50 million in green bonds to support Columbia University's Jerome L. Green Science Center. A $345 million portion of NYU's historic issuance is supporting the university's integrated technology, urban studies, and arts program facility at 370 J Street in Brooklyn. It is paramount that we continue to build on many of these successes. DASNY and the industries we serve face challenges that can be surmounted by streamlining our business and processes and thinking creatively to provide solutions to our clients. By pushing ahead, we will help New York State win the competition for the best minds and talent and expand access to healthcare. Now, on June 1st, DASNY hosted a conference in Central New York titled Alternative Methods for Financing and Delivering Student Housing. DASNY is leading an important conversation as higher education in a rapid evolution. The audience was a mix of public and private institutions, while each has different tools that can be deployed to execute projects, both must start from the same point, defining a project and its goal. Once those elements are fully understood, DASNY can help determine the best mechanisms to deliver the project. When there is a compelling need and that need is clearly articulated, there will be an opportunity to expand options. There are many pathways that can be taken to meet the challenges that will arise as the higher education industry undergoes change, and DASNY is moving in this new direction to ensure our partners continue to receive our full support. On June 6th, DASNY hosted a Minority, Women, and Service-Disabled Veteran Outreach event in Rochester. I highlighted the more than 30% expected MWBE participation rate on our design build project at SUNY College at Rockport. We described to the participants how the value-based assessment DASNY applies in assessing proposals for alternative delivery contracts enables DASNY to maintain and even enhance our commitment to MWBEs and SDVOBs. We also provided the opportunity for MWBEs and SDVOBs to network with construction managers, prime contractors, and consultants. It was attended by approximately 150 people. Now, last month, we also announced our issuance of approximately $150 million in low-cost tax-exempt bonds supporting capital projects as part of our partnership with SUNY. There were 9 releases in total, each targeting a different region of the state. The bonds were issued through the SUNY Dormitory Facilities Revenue Bond Program for residence hall capital projects across New York State. The releases resulted in at least 10 positive stories in every corner of the state on DASNY and the role we play in helping campuses meet their capital needs. Portia Lee will now provide you with a market update and a review of the annual bond state report.
Thank you, Troy. Portia.
Thank you very much. Behind tab 10 are the standard public finance reports. Since my last written report, we've priced 3 transactions, the school district pool, NYU transaction, and the financing for cerebral palsy. As to just a very brief market update, as you know, last week, the FOMC raised the Fed funds rate by 25 basis points, as was anticipated. At this time, it looks like the market is expecting one more rate hike this year. Overall, municipal supply thus far this year has been down as compared to last year by about 12%, although municipal supply this year is very high at $12 billion, which is the highest that it's been this calendar year. Municipal bond funds reported net inflows over the last week of approximately $395 million. We've talked a lot about sort of where rates have been and where rates were going. Since the last board meeting in May, the 10-year and 30-year MMD rates have decreased by 32 and 34 basis points respectively. It was interesting, we met with an investment banking firm within the last couple of weeks, and they were pointing out that actually rates are now at approximately where they were right before the election. Before I talk about the annual bond sale report, just to follow up on our meeting last month when we talked about the PIT and sales tax authorizations, I just wanted to come back and report to the board that we're working on the PIT refunding transaction, and we actually expect to bring that to market next week. We will be pricing. And we've also started to work on a sales tax new money transaction. Thank you. Included in the supplemental mailing to the board was the annual bond sale report. together with a cover memo that also includes the resolution that's before the members for consideration. The other thing that I would note is that in your handouts on the table is also sort of a summary slides on the annual bond sale report. So turning to the handout, on page 2, we provide this information to the board each year according to the bond buyer. DASNY was listed as the number 2 issuer in calendar year 2016. I would just note that this again, the bond buyer numbers are calendar year numbers. We report for purposes of the annual bond sale summary, the annual bond sale report on a fiscal year basis. If you look at page 3, you'll see that we undertook 33 financings for a total of $6.6 billion. As Jordan had noted, there was also one reoffering that we undertook just because of the way the rounding works. If you include the reoffering, it's 6.7 billion. I guess the other thing that I would just note for the fiscal year is that when you look at this in terms of the number of transactions, the first quarter and the third quarter of the fiscal year were particularly busy with 11 financings and 10 financings respectively, out of that 33 in total. On page 4, I would note, and I think Kim has referred to this in her presentation, that we did approximately $3.6 billion in financings on behalf of our public clients. That was actually in 11 different financings during the year, and there were 22 financings totaling approximately $3 billion that were undertaken on behalf of our private clients. There are in the pages that follow, we sort of break things down in terms of the various categories or buckets that we look at as far as the issuance is concerned. A lot of the information that's presented here you actually heard from in the context of Kim's remarks, so I'll try to keep my remarks brief. On pages 5 through 9, there are details in those various buckets of state-supported debt, other public debt, independent colleges and universities, healthcare, and other independent institutions. Just a few general takeaways. With respect to credit enhancement, again, not surprising, I would note that only the school district's financings used credit enhancement, which again, I think is pretty similar to what we've seen in previous years. Also, given the low interest rate environment that we've been in, there was significant refunding activity. One thing that I would note that you would see as you go through the actual bond sale summary reports, which are in the book, and which you do see periodically when we bring them to the board, is that there were a good number of private placements in the last year, and really for big institutions and small. And just to give you a sense, so we did private placements for 8 institutions: Memorial Sloan Kettering Cancer Center, Vaughan College of Aeronautics and Technology, Bank Street College, Siena College, Little Flower Union Free School District, which is a special act school, Parker Jewish Institute for Healthcare and Rehabilitation, Providence Rest, and Bright Point. I think we've sort of made that observation through the year as we've looked at these transactions, that we're seeing a number of private placement transactions, where I thought it was just worth noting in the context of looking at the transactions as a whole, sort of on the annual fiscal year basis, sort of how many private placements there were, and sort of the breadth of them in terms of the various sectors. On page 10 of the handout is summary information with respect to the TELP program. So you can see here in the last fiscal year, we undertook 8 TELP financings, a total of $144 million. You can see also what that looks like as compared to the previous 4 fiscal years. And on page 11, Charlie, this is a question that you had asked about previously. Page 11 shows you the last 5 years of activity with the under 10 million and over 10 million breakout. So,
But the under 10 million could have come before the board if it totaled over.
that's correct. That's correct. So if it was an institution, which in the aggregate in that 12-month period went over the 10 million, it would have come before the board. But I think in general, sort of what you're seeing is the transactions are getting larger.
Is there a general point at which it becomes economical for an entity to come before with DASNY on its help? I would imagine smaller lease transactions aren't economical from the client's point of view.
I'm not sure about that. I mean, I think that in general, just the savings from the tax exemption is meaningful to institutions. Certainly in orders of magnitude, you would see it more in larger transactions, with a bigger par amount, but I think it's still meaningful for institutions, even with smaller transactions. Although, as I had noted, and as I think you're suggesting, we are seeing that the size of TELP financings have been increasing.
There's nowhere else to go, is there?
Correct.
Pay full price.
Correct.
So even a little savings is better than not much. So.
But smaller healthcare institutions who aren't buying $25 million worth of stuff are still buying all of this technology. So are they being precluded from this market? Is this market only good for the big people? And should we be, what has happened here at DASNY in the past is we consolidated bonding efforts for school districts so they could benefit from the savings that DASNY provided even though they were small districts. Is there an opportunity for us to consolidate TELP financings for small healthcare institutions so they save money?
So I think two things. One, I think Gerard has been very focused on the TELP program and how it is that we market that program to make sure that we're not missing out on those types of opportunities for institutions, really looking at, the kind of question that you're raising. Are we reaching deeply enough into the market? Are we looking at all the possible institutions that we could be working with? And I think we certainly, we're spending some concerted time and effort really thinking through that issue from Gerard's point of view and direction. As to your question, though, as to pooling them, I don't think that that's something that's really possible for this program because each of the institutions brings its own credit strength, and that's something that is taken into consideration for each of the financing. So there's no way to sort of quote homogenize the credit, which is what you would need to do from a pooled perspective. The school district financing has the benefit of the intercept, and the intercept is what is technically homogenizing the credit. So that I think that's the difficulty.
And property taxes.
Pardon me?
And property taxes for school districts.
I'm sorry, I didn't hear you.
And property taxes.
And property taxes, yes.
Two basic revenue sources of revenue.
Yeah.
Sure. Guaranteed.
Yeah.
In effect.
Well, guarantee is strong.
To an extent.
Yes.
Commissioner, just looking at this chart, I just want to be sure. If I look at any one year, 2016, 2017, is it as simple as adding 6 and 2 and saying we have 8 action items that came before the board? How many times were we taking up?
I think to Charlie's point, we certainly had 6. We might have had 8 if the 2 that were under 10 million when taken in the aggregate for each institution exceeded 10 million.
But
You know what I mean?
Leases named 6 separate.
Correct.
Well,
Correct.
It surprises me that it's such a low number. I mean, just in my memory, it would seem that we have 1 or 2 every month.
Yes.
But,
I agree.
Yeah. And
but you didn't. We had only had 6 all year.
So that's what we're looking at. We are trying to assess where are institutions going with their technology needs if they're not using TELP. So that's first and foremost. Then we're thinking through sort of the big and then the smaller universe. How can we reimagine this program and reintroduce it? So right now, Portia and our team are putting a lot of data together to see where this stuff is coming from. And then we're going to try to rebrand this and get it out. So we're really, I mean, the big issue is if you see 6, one thing about hospitals, technology is very important in a hospital. So if we're seeing 6 here, where are these other institutions procuring your technology needs? So that's what we're really going to go back and talk to people about, well, here's TELP, okay? And if you're not using TELP, where are you going? And so let's try to create something, a solution that can match that. So that is something that Portia, Art, we've got Freeman and his team, and a couple of other folks just, again, rethinking how do we get this information out.
And that was part of my earlier question too, about which items come before the board and which don't. I mean, is that an issue because it delays the action, or because the ones that come before the board and the ones that don't, is there an advantage there? As well as I was also thinking about whether it was an appropriate dollar level for the board to have to deal with, but also whether or not it impacted the program.
We're doing analysis of all of that right now. I mean, there was a general sense that we might not be capturing some of this because some of the bigger institutions are capturing this in their aggregate finance, right? So you don't see it through that. But we want confirmation on that. We need more data.
Mr. Chairman, that concludes my report.
Thank you. The annual bond sales summary report requires board approval. There is behind tab 10. There's the annual portfolio monitoring report, then there's the bond sale report memorandum from Portia, and attached to that is the very brief resolution which, if approved, will result in the approval of the annual bond sale report. If you've had a chance to read that, take your time if you haven't seen it. It's very brief, but it's Portia has her portfolio monitoring report in there, and then the annual bond sale report, which is a 1.5-page document, and clipped to that is the resolution dated June 21.
And it would have arrived together with the annual bond sale report in
Yes.
case the book is in a different place.
Yes. Did everybody have a chance to find it and take a look at it? It's a very simple resolution. May I have a motion, please, to approve it? Thank you, John Johnson. A second, please. Sandra, thank you very much. All in favor, please indicate with aye. Aye. As there is no opposition, the motion carries unanimously. The TELP report does not require a resolution, as I understand it, and therefore there's no action for the board to take on that. We're at that point in the meeting, I believe, where I am going to ask the board for a motion to go into executive session to discuss the financial and credit histories of particular corporations. May I have a motion? Thank you, Sandra. Is there a second? Charlie, thank you very much. All in favor, please indicate with aye. Aye. There is no opposition. The motion carries unanimously.
All right, we've come out of the executive session where no action was taken. I will note that the chairman had another obligation they had to leave, and so that's why I will chair the balance of the meeting as the vice chair. So the next on the agenda.
So Steve will now provide you with an update on the construction division board.
Okay, I'm just going to go through a couple of projects. I'm going to skip the cover project. I'll just start with the Court Officers Training Academy. The project schedule is slipped from June to July 2017 as reported by our general contractor. Work continues in all 3 buildings. TCO requirements matrix has been developed. We're getting closer, but still much to do to get to the TCO. We started the Brockport project. The early site work package has begun. A final design package is with DASNY for design review and approval. Anticipated completion is July 2018. Javits and Moynihan, quick updates. The transformer building at Javits, foundations and the steel frame are complete. The Javits Center itself, we're expecting an early foundation package for review next week. And at Moynihan, early construction work continues. A larger package is due to DASNY in the fall of 2017 for review and permitting purposes. We picked up 80 new minor maintenance projects from OPWDD that we're going to start shortly. All SUNY summer work is underway. The DOH lab, we selected, DASNY has advertised for a bridging architect and a market sounding consultant. We selected a market sounding consultant pending agreement on contract terms. We anticipate both procurements will be completed by the end of summer. NYCHA and Gozer are moving along, and that concludes my report.
Are there any questions?
Just one. Steve, the legislature apparently is not going to act on expanding the design bill authority, to expanding it to other entities. Does that affect us either way?
It doesn't impact SUNY. We have design build capability with SUNY as well as any project delivery methods. So it doesn't affect what we have to do.
So it doesn't affect us positively because others aren't getting it.
Say that again.
It doesn't affect us positively that it isn't being expanded.
Is there an upside to it?
It does.
Could you just say that one more time? It doesn't affect us.
The fact that they are not expanding the ability to other entities
Yes.
to do so, does that affect us positively?
I would say no.
Okay.
No. Neutral.
Any other questions? Next, Gerard. What's next on the agenda? We have financial report. That's right.
No, hold on. Got
Mike, you're done.
We've got the annual procurement report. Paul Koopman is,
Yeah.
it's gonna be short. He's done, he and his team have done an incredible job to collapse this.
Oh, completely. Yeah. Good afternoon. So as required by the Public Authorities Law and our procurement guidelines, we are required to file an annual report on our procurement contracts, and I'll provide a brief summary of that report. We had one amendment to the procurement guidelines. This was the addition of CM Build to our definition of allowable alternative project delivery methods that was approved by the board in October of 2016. In the area of alternative delivery, as we've highlighted, I would note that we did one design build contract, which was with Purcell Construction for approximately $21 million. That was our first design build agreement in quite some time, and as reported, we are pursuing that project.
What is that for? What project
The Brockport Dormitory. Okay. Some of the financial highlights. The total awards for the year were $497 million. That was comprised of $10 million in professional service contracts, $449 million in construction contracts, and approximately $39 million in purchase orders. From a dollar perspective, that was an increase on the construction side of about 66%, primarily due to the award of several large construction contracts at South Beach Psychiatric Center. That's a project that went into construction during the fiscal year. In addition, we continue to make extensive use of our term contract and job order contracting programs. These are on-call contracts that generally allow us to provide a faster procurement method than our traditional methods. For those programs in the term consultant area, we issued approximately 1,100 work authorizations valued at $88 million. In addition, on the job order contracting side, we issued approximately 500 work orders valued at $136 million. So combined with the new awards and the job orders and the work authorizations, that put about $633 million in new encumbrances on our books during the fiscal year. With that, we'll close. Any questions?
Thank you. You want to show them size of the report?
And we have an abridged version of our report, yes. We slimmed it down a little bit this year to make it a little bit more efficient to produce and read.
It was nice. All right. Well, we need a resolution. We need a resolution to approve it. Is the resolution
In the pack.
in the package? Yes. I assume that everybody's seen it. Do I hear a motion to?
So moved.
Second? Second. All those in favor, aye? Aye. Carried. Now, financial report. Kim? You've given us a lot of reports.
I'll keep this brief. I have one addition to the financial statement, the information that provided earlier. The audit committee last evening did vote to take the option in the KPMG contract. We had previously approved the contract for 3 years with 2 one-year extensions. The audit committee approved the first of 2 one-year extensions. That will apply to the fiscal year 2018 audit.
Does that apply to KPMG and
Watson Rice.
Watson Rice.
It's, KPMG has the contract
Yeah,
with
with them.
Watson Rice, and
All right.
it is their intention to continue the relationship that they have. I didn't have anything further on the financial items that were included in your package. I do have one resolution for your consideration. We had one of our employees in our investments group leave, who was authorized to transact in terms of our security purchases and sales. We have a revised listing for your consideration that will remove this individual from the authorized.
So moved.
All those in favor, aye?
Aye.
Carried. All right, anything else come before the board? Yes or no?
I have my memo, self-training on Project
Yes,
Sunlight.
that's what I was just gonna
Call
ask
in
you.
to Diane when you're done.
Yeah.
Just read through the materials and call us with any questions. Thank you.
What's that? Which one is that?
Project Sunlight.
Project Sunlight.
Oh, Sunlight, yes,
Yeah, yeah.
yes.
I did the memo. Materials are there.
This machine made.
I'm done, right?
All right, with that, I will hear a motion to adjourn. Second. Motion second. All right.
Aye.
And everybody can vote with their feet.
Thank you. Thank you. It's a long meeting. Thank you.